Welcome, curious minds, to the deep dive. Today we're plunging into a topic that honestly touches every single one of us, investment risk. Whether you're deep in financial markets or just figuring out your savings, this matters. We really want to unpack how understanding risk isn't just for the finance pros. It's actually crucial for anyone looking to protect and hopefully grow their money. Now, you might hear investment risk and immediately think, oh, that sounds like textbook stuff, maybe for exams like the TCT, the tax compliance professional one. But honestly, the insights we're digging into today, they go way beyond that. Our goal here is to give you a bit of a shortcut, make you feel really well informed, maybe share a surprising fact or two, and hopefully keep it interesting so you see your finances in a new light. Before we dive deeper, just a quick reminder, a lot of the insights and the actionable knowledge we're about to explore, they're largely drawn from the incredibly clear and comprehensive materials provided by Farhat Lectures. All the content, examples, explanations, it's all derived from the comprehensive accounting resources over at farhatlectures.com.
So whether you're an accounting student, maybe you're studying for the CPA exam, or even a seasoned professional, definitely check out the website. They got additional practice questions, video lectures, detailed support, all to help reinforce what we talk about today. And a special thanks to Professor Farhat for making this really valuable material available to us. Okay, so let's start right at the beginning. When we just say risk, fundamentally, what are we actually talking about? What are we trying to dodge?
Well, at its core, risk is basically that that possibility of something going wrong, right? A threat that could stop you from reaching your goals. And when you apply that to investing, it gets pretty stark. It's the risk of losing money. Plain and simple. Imagine you put, say, $5,000 into something.
Yeah.
You're hopeful. Then you look later and it's only worth $2,000.
Coach.
Exactly. That $3,000 gap. That's your risk becoming reality. It's seeing your capital just shrink.
Right. And this leads to that fundamental principle in finance, the one that gets thrown around a lot, the direct link between risk and return. That's where it gets really interesting, I think.
It really does. And what often gets missed is that it's a trade-off. If you take practically zero risk, like stepping cash under your pillow, guess what? Your return is zero.
Makes sense. Safe, but not growing.
Precisely. And inflation's eating away at it silently. Now, move up slightly, maybe a bank savings account. Low risk, sure, but you might get, 1%, a tiny return. But then you venture into things with higher risk, like stocks. That's where you get the potential for much higher returns.
Potential being the key word there.
Absolutely key, because that potential cuts both ways. More potential reward means more potential for, significant loss. It's not just about what you could make, but also understanding what you might lose. And this is important for you, listening in, especially if you're maybe a CPA or in a related field, even if you're not giving direct investment advice. Understanding these risks, being able to talk about them, it's vital for good financial planning. It's about making sure clients or even yourself know what they're getting into, not just chasing returns blindly.
That's a really solid point.
Yeah.
So investment risk isn't just one big scary thing. We can actually break it down into two main types, non-systematic and systematic risk. Let's tackle the first one. Okay, so non-systematic risk, sometimes called business risk. What exactly is that? How's it different from, the whole market going down?
Right. Non-systematic risk is fascinating because it's very, very specific. It comes from factors unique to just one company or maybe one particular industry, not the whole economy. Think of it as the risk of a single company kind of tanking itself because of its own internal problems, issues with its products, its management, how it operates.
Okay, so if it's specific to just one company, what's the defense? My gut says diversification. Don't put all your eggs in one basket.
Exactly right. Diversification is your main shield against non-systematic risk. Instead of pouring all your money into, company alpha, you spread it out. Some in alpha, some in beta, gamma, delta, epsilon. Even better, spread it across different industries or different types of assets, stocks, bonds, maybe real estate, gold. The whole idea is if one investment takes a hit, the others might be doing okay or even well. It cushions the blow. Softens the impact if one company has specific trouble.
Could you give us some concrete examples? Like what kind of company-specific problems are we talking about?
Sure. Our source material points out several good ones. Product risk, for example. This is where a company's whole future might depend on just one or two products. Think about a small biotech firm. Everything hinges on getting FDA approval for one drug. If it fails, the company could be wiped out.
Wow. High stakes.
Very. Contrast that with a giant like Johnson & Johnson. They have medical devices, drugs, consumer goods, a huge portfolio. If one product fails, it's a setback, sure, but it doesn't sink the whole company. Then there's competitive risk. A new competitor comes along with a better product or maybe lower prices and suddenly drives another company down, maybe even out of business.
Yeah, we see that happen.
We do. Also, default risk. This is crucial for bondholders. It's the risk that the company you lent money to simply can't pay you back your interest or the original amount. And management risk. What if a key leader leaves? Imagine Elon Musk leaving Tesla suddenly.
Yeah.
Or what if management makes a terrible strategic decision, like killing off a popular product line? That can really hurt a company. Beyond those, you've got supply chain risk, can't get raw materials. Reputational risk, think about a big data breach, losing customer trust. And even legal risk, getting hit with major lawsuits. All of these are pretty specific to the company itself, and that's why diversification helps manage them.
That makes total sense. So non-systematic is about the individual players. But what if the whole game gets rained out? That leads us to the other category, systematic risk. This sounds bigger. So if diversification doesn't save you here, what is systematic risk and what does it mean for your investments when it hits?
Yeah, systematic risk is the big one, the one that feels unavoidable sometimes. It affects the entire market, the whole economy. The classic example, the one everyone remembers, is the 2007-2008 financial crisis, the housing crisis. Back then, pretty much everything went down. Stocks, real estate, bonds to some extent.
Right. It didn't seem to matter what industry you were in.
Exactly. Tech, real estate, electronics, consumer goods, almost everything got pulled down together. That's systematic risk. It's market-wide, economy-wide, and unlike non-systematic risk, you can't just diversify it away by holding different stocks. When the whole tide goes out, well, it affects almost every boat.
So if diversification doesn't work,
Yeah.
how do you even deal with that? It sounds much harder to manage.
It is much, much harder. There are sophisticated strategies, things like using derivatives, complex financial contracts used for hedging, or even short selling.
Short selling, that's betting on things going down. Right?
Basically, yes. You borrow shares, sell them high, hoping to buy them back lower later to return them. You could short sell a broad market index like the S&P 500, or maybe an ETF like QQQ that tracks the NASDAQ. The idea is if the whole market falls, your short positions could potentially make money, offsetting some losses in your regular investments, but these are complex and risky strategies themselves.
Okay, so these are the big unavoidable waves. What kind of things actually cause this systematic risk? What are the triggers?
Well, the sources point to several major drivers. Political risk is a big one. Think about major changes in government policy, new tax laws, sweeping regulations that affect whole industries, or even political instability like civil unrest or wars. These things can really shake entire economies.
Right, things that are way beyond any single company's control.
Totally. Then there's just market risk.
Yeah.
This is the general risk that investments decline because of broad economic trends, like a major stock market crash where fear takes over and people just sell everything. It hits almost all stocks. Currency risk is another. If you invest in companies that make a lot of sales overseas and the currency in that foreign country tanks, say billions in Russian rubles suddenly become worth only a few million US dollars when translated back, that severely hits the company's reported earnings.
Yeah, that makes sense.
We also have inflation risk or purchasing power risk. This is the sneaky one where inflation just eats away at the real value of your returns. $1 million today buys less than it did last year. And sociopolitical or geopolitical risk. Think big events, major social unrest, geopolitical tensions that don't just affect one place, but ripple through global markets and change how investors feel everywhere.
Okay.
And finally, liquidity risk. This is the risk you can't sell your investments quickly without taking a big price cut because there just aren't enough buyers. We saw this big time in 2007-2008. Even good assets couldn't find buyers at reasonable prices, causing prices to plummet further. It's a market freeze-up.
Wow, okay, so those are the big forces. Now let's shift gears slightly to the actual tools we use for investing. The sources talk a lot about the two main ones, stocks and bonds. Can you break down the core differences for us?
Absolutely. Let's start with stocks. These are equity securities. When you buy a stock, you're buying ownership, a small piece of the company.
Right, you own part of the business.
Exactly, and that gives you a claim on their earnings. The stock's value can go up or down, sometimes dramatically, based on the company's performance, its industry, what the market thinks. If the company does well, hopefully the stock price goes up, and maybe you get dividends too, a share of the profits. But, and this is important, stocks are generally seen as the riskier of the two, the biggest risk. You could lose your entire investment.
All of it.
Potentially, yes. If the company goes bankrupt, the stock can become worthless. Zero. Think Lehman Brothers or maybe retailers like a Radio Shack that just disappeared. Shareholders are usually last in line if a company folds.
Okay, so that's stocks. What about bonds? How are they different?
Bonds are fundamentally different. They aren't ownership, they're debt, they're essentially loans. When you buy a bond, you're lending money to whoever issued it, could be a company, could be a government. In return, they promise to pay you regular interest payments over a set period and then give you back the original amount, the face value, when the bond matures.
So like an IOU with interest.
Pretty much, yeah. And generally, they're considered less risky than stocks. As a bondholder, you're a creditor. If the company gets into trouble, creditors typically get paid before shareholders. Now, within bonds, there are two main types we should touch on. Corporate bonds. These are issued by companies. They need money, maybe for a new factory or research, and instead of going to a bank, they borrow from the public by issuing bonds. Might get a better interest rate that way.
Okay.
But here's a key tax point. The interest you earn from corporate bonds, it's taxable. Federal income tax, state income tax, you owe tax on that income.
Got it. Taxable interest. What's the other type?
The other main type is municipal bonds, or munis.
Yeah.
These are issued by state and local governments, cities, states, counties. They use the money for public projects, building roads, schools, hospitals, that kind of thing.
Things the public uses.
Exactly. And munis have two big advantages. First, the interest is often exempt from federal income tax. Sometimes state and local taxes, too.
Why is that?
Well, the federal government gives them this break because they're funding essential public services. It helps lower the borrowing costs for local governments. The second advantage is they're generally safer than corporate bonds. Why? Because governments can usually raise taxes if needed to pay back their debts.
Right. That's a power companies don't have.
Exactly. But there's a trade-off for that safety and the tax break. Municipal bonds usually offer a lower interest rate, a lower return, compared to taxable corporate bonds.
Okay, that makes sense. Lower risk, lower return, plus the tax benefit. Now, you mentioned taxes. There was an interesting point in the sources about borrowing money to invest in bonds. How does the tax treatment work there? It seemed a bit tricky.
Yes, that's a really important nuance based on tax symmetry. Let's break it down. If you borrow money specifically to buy corporate bonds,
Okay.
the interest you earn on those corporate bonds is taxable, as we said. But the interest expense you pay on the loan you took out to buy those bonds, that expense is deductible. It cancels out, in a way. Taxable income, deductible expense. Fair enough.
Okay, that seems logical.
But now, what if you borrow money to invest in municipal bonds? Remember, the interest you earn from munis is tax exempt.
Right, that's the big drop.
Because that income is tax exempt, the interest expense you paid on the loan you took out to buy those munis is not deductible.
No.
The logic is basically you can't have it both ways. You can't get tax-free income and also deduct the cost of financing that tax-free income. So if a business borrows to buy muni bonds for, say, a public transit project, the interest earned is tax-free, but the interest paid on the loan is not a write-off.
Gotcha. No double dipping on the tax benefits.
Oh.
Okay, let's try to tie this together with a practical example. Imagine a company needs cash, maybe for a big expansion. Why would they choose to issue corporate bonds? What's the main driver based on everything we've discussed? Is it about their own portfolio, avoiding dividends, boosting their stock?
Good question to ground it. Looking at the options, the main reason a company issues corporate bonds is simply to raise funds for its projects and operations.
So it's about getting the money they need.
Exactly. Issuing bonds is borrowing money, just from the public instead of a bank. It allows them to access capital, often large amounts, potentially on better terms than a loan. It's not about diversifying their own portfolio that makes no sense for the issuing company. It's not primarily about avoiding dividends, though it is debt financing, not equity. And while successful projects financed by bonds might eventually help the stock price, that's a secondary effect, not the core reason for issuing the bond itself. The fundamental purpose is funding, getting the cash needed to operate and grow the business.
Perfect. That really clarifies the why behind corporate bonds. So wrapping this up, it feels like we've covered a lot of ground. The core link between risk and return, the big difference between those company-specific risks, the non-systematic ones,
You can diversify.
and the big market-wide systematic risks you really can't avoid easily. Plus, the key features and, importantly, the tax differences between stocks and bonds.
Yeah, and thinking about all this, the real takeaway isn't just knowing the definitions, right? It's about how this understanding empowers you. So maybe a final thought for everyone listening. Given everything we've talked about, the different risks, the different investments, how might knowing this stuff actually change how you approach your own financial decisions? or even just the conversations you have with a financial advisor, especially when you're trying to figure out how much uncertainty you're truly comfortable with to chase those potential returns.
That's a great question to reflect on. Understanding this really can make you a more discerning, more confident investor, or just more informed about your own financial path. Really appreciate you breaking all this down for us, and thanks to all of you for joining us on The Deep Dive.